Fitch has downgraded the USA's credit rating to AA+ from AAA. Bonds are shrugging off the downgrade, or at least they had been, but they're surging now, decidedly unlike the move last time that was made by Standard & Poor's in 2011. For more on this, we turn to Steve Laipply, BlackRock Global co-head of iShare's fixed income ETFs for this week's ETF report, which is brought to you by Invesco QQQ. Steve, you were in the thick of the global financial crisis, as I understand, with maybe two firms, but just tell me what you saw back then and how that might be a little bit different from what we're seeing today.
Yeah, Jared, I think we were in a very different environment back then. So if you recall, 2011, we were coming off of the financial crisis. We had debt crises across Europe, Southern Europe in particular. Interest rates were near zero. I think at that time, the U.S. Was viewed as the safe haven, irrespective of the downgrade. I think that's continuing today. So what you're seeing in the backup in yields, we think is largely a reflection of the Treasury supply coming in. You did have a strong ADP number this morning, but I do think there's, the amount of supply that's coming in through the refundings, we up from, I think, 96 billion to over 100 billion. The amount of issuance is going to continue to go up. Higher interest rates obviously are contributing to part of that. So I think it's more that than the reaction to the downgrade.
And let's talk about what has been happening year to date in the bond world. We've seen ETF flows, that's according to your notes, I believe, of $55 billion. About 16, almost 17 billion has been in one ETF alone. That's TLT, which tracks longer-term bonds. Just talk to me about this love for bonds that we seem to have right now.
Yeah, I think investors have reacted very strongly to the repricing of yields last year. It was a great reset in yields. We have not seen yields at these levels in well over a decade. I think investors responded by retooling their portfolios. So if you go back a few years, you would have to be in high yield to get a 5% yield. Now you can do that on the front end of the yield curve. So I do think what you're seeing flow-wise, we saw over 100 billion in fixed income iShares last year. We're at 55 this year, so we're on track to see similar flows. But in particular, investors have been moving out a bit in duration. So TLT reflects that. We've taken in around 16 billion. That, to me, is a reflection of investors saying they need to start adding ballast. It's very hard to time markets. Obviously, the long bond's down today, right? But it's hard to get the timing exactly right. But they've been strategically moving out in duration as a function of adding some ballast to their risk assets.
And in the ETF world, we saw smart ETFs rise in terms of equities, and now we're seeing similar strategies rise in active trading of bonds. Just tell me about what are some of the newer developments in the bond world and the ETFs that cover it.
I think you're starting to see, in terms of product innovation, you're starting to see more active ETFs. You're starting to see more defined payout ETFs. So as an example, we just launched just in the past month, we launched BINC, which is our income fund run by Rick Reeder's team. That is designed to be a complement to a core exposure like the aggregate. So it allows advisors to pair a low-cost core bond exposure like AGG with a plus sector or higher income fund, which is BINC, and it allows them to be in the driver's seat in terms of how to modulate between those two. We also launched last year in August our buy right suite. So that's the covered call. People are very familiar with that in equities. We did that in fixed income with our flagship tickers TLT, LQD, and HYG. Those products on a trailing 12-month basis are generating high teens in terms of yield. So
it's impressive.
It's approaching
sounds like crypto numbers almost.
It's approaching. I think we're at 850 million across the suite. TLTW alone is 700 million. So they're growing very, very rapidly.
All right, and what's coming down the pike? What can we look forward to in the future that we might not have?
I do think you're going to see more of these tailored products. So a lot of the vanilla index exposures, those have been done. They're large, they're liquid. We are seeing those products being used very much in an active context. So you're seeing active managers using traditional index ETFs to generate alpha. What we're starting to see on the wealth side is a desire for more of these tailored exposures and active exposures. So I do think you're going to see more active ETFs. I do think you're going to see more tailored payout exposures along the lines of buy right type exposures.
Interesting. They call it a stock pickers market sometimes. Maybe it's a bond pickers market currently. We'll have to have you back to talk about more of that as it develops. Steve Laipply, thank you for dropping by.
Thank you.